What's going on, everybody? David Ramsden Wood here with Mark Rossano for our pre-game show to kick you off for the Primary Vision weekly economy and economic show. Mark, how are you this week?
Pretty good, with a lot of things happening, a lot of movements with vaccines. IMF is taking up their GDP estimates for 2021. Everybody feels pretty good about where the world is headed right now.
I love it. Okay, so we're going to try and do this in rapid fire format so that people can tee off into the show they really want to dig in. And we have to start with China because at the end of last week, Pompeo, with the support of the Biden administration, declared that China was a genocide, which, as I understand from the UN, means that the United States now has to do something once they made that declaration. And this is something we didn't even do for Syria. So that seemed to escalate tensions with China. And then immediately we saw some aircraft carriers, cruise ships going in the China Sea. Mark, what's going on in China?
So right now, China is going to start to act out and really respond to the commentary. So what did they do instantly? They sanctioned a bunch of outgoing Trump administration to put sanctions on them, not allowing them into China. Not that I think any of them were heading there anytime quickly. Then they immediately sent, I think it was a total of about 8 aircraft over the Taiwan Strait. We then turned around and sent an aircraft carrier through the region, really kind of clarifying, look, we're here, we're not going anywhere. In last week's show, we really showed the freedom of navigation. What does that mean in terms of how many have we sent through since 2015? It's not stopping. The Biden administration was okay with the leverage, and then the thing that we're going to talk about this week is President Xi spoke at Davos. He was talking about how everybody has to come together. There can't be friction. Everyone has to be friends. There can't be bullies, and it's you kind of look at this. It's like, guys, Are you looking in the mirror? Like, what are you talking about? You can't be bullies. Like, you're literally the biggest bully in the street right now, especially with the people around you. And we're going to build kind of an arc around what does that mean and what does that mean for trade. China, India is starting to ramp up. India just banned a new round of apps within the country, so there's more friction to come within that construct.
So we're watching obviously what's going on with China, and you'll talk about it because the numbers are impactful. They also came out last week and said that they were seeing coronavirus cases, and it feels very reminiscent about 2020. So tune in for the China segment in the Energy and Economy show that Primary Vision puts out with Mark. I want to pivot because I think related to last year at this time, the next country that was really a tipping point for the coronavirus itself was Italy. And, there's been discussion around what social media campaigns may or may not have been done in Italy, done by China to spread mass fear. But this week, the president of Italy resigned. I'm curious what that's going to do for Europe and overall for the economy and economic activity in that country.
Yeah, so when you think of the prime minister who resigns, as political, the tensions rise. They just passed and pushed through a 32 billion euro stimulus package. So the prime minister, he did win the confidence vote, but there was a concern that he wasn't going to win the Senate confidence vote. So he preemptively resigned. His party still has the lead in terms of creating a cohesive government. So essentially, you resign. You tell your cabinet that you're resigning. You then go back to the drawing board. You try to build a coalition, and then take the next step forward. It's just showing that there's a lot of strife and a lot of issue within Italy itself. And the reason why we focus so much on Italy is that is a big point of entry for China into Europe along the Belt and Road Initiative, when we see a lot of movements coming on, but not only just rail, also by sea. So the question is going to be, Italy has one of the bigger issues when it comes to debt. They're at about now 134% of GDP on a debt level. There's going to be more to come because their shortfall is only rising. They're trying to stimulate more and more. So the question is going to be, how much can the ECB really backstop? Because Italy is going to remain to be kind of that weak point to watch. The CDSs, or the credit default swaps, were really starting to widen out yesterday, tightening up a little bit today. There's a bond auction that's coming off, that's going to go off today, that should kind of give a little feel for how is the market really anticipating some of this Italian shakeout. Right now, because of the ECB in Germany and the EU in general, I don't expect much, but this could be one of those linchpins where the domino could start to fall.
Now, let's pivot because I think it's related. Obviously, we talked about at the top of the show. The economy is really raring and everyone's excited and the market's been going up. At the same time, we have coronavirus. We have different strains. We have that Biden has sort of added travel bans from South Africa. We've seen action in the UK. And then I saw an article you posted yesterday on Twitter that, again, I can no longer believe or not believe any of the things we see because they're pushing narrative. But there was something along the lines of the vaccine in Germany they're seeing is the AstraZeneca one is not super effective for people over 65, which seems sort of counter to the whole benefit of the vaccine. Can you comment on that and coronavirus and what we're seeing over the last week?
Sure. So we've seen a lot of issues with the vaccine logistics, which isn't really surprising if you consider that we're trying to go from 0 to 100 in a straight line, and there's always going to be hiccups along the way. And AstraZeneca was really the first to show some pain with that. They cut their deliveries into Europe by about 60%. There's concerns about Pfizer. They've had to cut their January deliveries, promising to keep their Q1 deliveries. But the issue is it's coronavirus. As we've been talking about, it's going to mutate, it's going to change. Now the South African strain is the one that's the most concerning because it's pivoted enough to the point where there is question about what is immunity, will this vaccine work? Pfizer has come out and said that they will be able to Moderna came out and said that they can get something essentially up and running for that specific strain within 6 months' time. There's now talk of needing a booster by within either month 12 or 14, so that would actually be a third shot. And then it's just a matter of how much do these pivots continue to go through. So Israel has also seen some issues with efficacy. There's commentary that it's not hitting that 95%, but it's actually coming in lower. It's still effective in terms of just being some sort of normalcy into the market. Then they have seen people that have been vaccinated, their numbers of positivity are falling. So obviously it's having a positive impact. But just in terms of actual effectiveness. Now, what you were talking about, they're seeing that in Germany. They're seeing that in some of the Nordic countries as well, where it's just not as effective for people 65 and older, but more specifically 80 and older, which is some concern in terms of, well, that was an area that was at high risk and it's really not working. Right now, the vaccine optimism still is out there. The IMF actually took their estimates up now for 2021, and the headline is now projects 2021 will be the best year for global growth since 2007. Obviously, 2020 is a low point, so you have the base effect. But this is where we keep struggling with where are we going to see 2021. We're not this optimistic. Just looking at not only leading indicators, European slowdowns, as we'll talk about. German economic data really took a turn for the worse in terms of where we were in December and where we are in January. That's really leading to those lockdowns, the stringency indexes that we follow. And Europe is really trying to button up to stem some of the flow, not only of the new strain from the UK, but also the one that seems to be a bit scary coming out of South Africa.
It seems like the market continues to take it in stride, though, and that optimism reigns supreme. Are you seeing more severe warning signs this week than last week, or do we just continue along the everything's good until it's not tact that we've been on for the last few months?
I think there's really nothing to shake the market at this point. Some of the European data has gotten much worse, but in the U.S., some of the data is still mixed. We have some leading indicators that are quite positive. Some of them is really being driven by really what's going to end up being inflation. But again, there's still some positivity within it. Some of the employment numbers in terms of factories and manufacturing that are looking to hire starting to increase, positive for jobs. We're seeing the exact opposite in Europe, which is the more concerning side. And then last week, we went deeper into some of the Chinese data points and why we think some of the Chinese data points are getting a bit concerning. And you mentioned at the top of this, where we were looking at China right now heading into Lunar New Year. Expectations are for a drop of about 30 to 40% from 2019 travel. We're going to talk about that in a bit more detail, not only to what is it going to mean on the economy level, but also on oil demand and what does that mean for gasoline, diesel, because that's going to be a big impact to not only just retail sales, restaurants, and other, but also travel. And it's kind of a weak starting point, if you will, for the Chinese economy.
Yeah, and so we'll leave that for your show so people can dig in. But the takeaway that I got from you and I talking about it last week is, as China has moved to more lockdowns locally, moving into the lunar travel season, that perhaps, I look back to last year, Chinese demand was down 30%, roughly 3 million barrels a day, and we saw $12 a barrel come off the price of oil. That doesn't seem to really be factored in. And then you have OPEC. Let's talk about oil for a second, where last week, at the end of the week, I guess around inauguration, President Biden signed a couple executive orders, one of which impacted a drilling moratorium, and not drilling, but like a permit and new leasing. And so both of us would say the reality is most companies have years of inventory, but it does impact rights of ways. And so if companies didn't have everything buttoned up, they might be able to drill or complete a well, but they might not be able to get it tied in. And I would expect that future permits will definitely have some greenhouse gas emissions, methane emission flaring add at the end of the 60 days. What other color would you add to that as we get to the EIA commentary?
So the water rights was something that came out ahead of the EO, which is what gave me some confidence that one of them was coming. But the water side is interesting because a lot of these companies started to in-house their takeaway capacity, whether it was by truck and or by pipe. Now, the issue is that, fresh water, you need fresh water to finish a well, to frack it, to complete it. And with taking those rights away once they expire is just going to mean that you're going to have to truck water in and out, which is more expensive but doable. The bigger issue, which you alluded to, is those takeaways on natural gas, which is a much bigger component because you're really not trucking natural gas. Like that is, you're either flaring it or you're not completing it, or because you really need to tie in order to adjust. So taking that away, even though you have permits that can run for 4+ years, and it just based on the current trajectory, taking away those tie-ins is going to be massive, and that will really put a hindrance on what those completions can look like if you can't tie in on the gas side.
And so when you overlay that with the backdrop of demand and then supply continuing to dwindle, with Saudi cutting 1 million barrels, we saw that Iraq this week said that they will come in with their compliance cuts, which seems to be supportive of the market. And then we have just general euphoria. Are we still thinking oil hits 55 before it hits 50 from what you've seen? And how did the EIA data look last week?
So I think it does hit 55 before it hits 50, and there's two counterpoints. So one, like as you said at the beginning of last year, it was a little different. You had production at different levels. You had Saudi Arabia that launched into this a little bit of a price war. Well, not a little bit. There was a lot of a price war, and right now there's something a little bit different. You have Iraq, which took about 200,000 barrels out. Went from about 3.8 to 3.6. So we're not talking about a huge number, especially if you consider that Norway has really replaced a lot of that. And then when you shift over into West Africa, there's an interesting dynamic happening right now. So Nigeria actually cut February official selling prices, and they actually took them to the lows that we haven't seen since 2016. And it's actually 2016 was a little bit lower, but it's the second lowest it's been in 10 years. Now take that and let's look at Angola. Angola is actually cutting more prices because they can't clear out March, and they still have about 5 cargoes to go in March, which is a lot for this time of year. And they just shaved about 20 cents to 30 cents off of every offering, which is a big problem when you consider about the quality of crude. Now, in terms of who wins in all this, it's our good friend Russia. Urals are actually back to Feb highs, which is surprising, if you will, if you consider about what is Saudi Arabia doing, what is the actual goal. So that's a long way of saying that I think at this point, There's going to be some tightness depending on the grade, and I think that that's going to be enough to really help the U.S. push to about 55 before we start to see a bigger correction.
Okay. So we've touched on China, we've touched on Italy, we've touched on the coronavirus, we have touched on EIA. This is the show that sets you up to be able to do a deep dive with Mark into the primary vision, economy, and energy shows. You can click on the links to go in. Appreciate your time. Any other closing comments for us today, Mark?
Yeah, one of the things that I should close out with the EIA numbers. So the EIA was a bit bearish on the oil side, a bit more bullish on the product side. The product side is something where we think gasoline's going to remain at about that 8.1 to 8.2 million barrels a day of demand, which I think is going to be misconstrued as this really bullish thing that we're going to get this surge. But realistically, a lot of things have normalized for daily life within reason for the most part, which I don't think you were going to see too much of an aggression movement to the upside. Crude is going to be an interesting one because we do have more frac spreads. We have more production in the U.S. that's going to hold this 11 million. We're going to get a little bit more imports as we get refiners getting a bit more active into the end of the month. But again, distillate is one where there's not a whole lot of demand abroad, and there's a lot of product floating around. So I expect kind of an inline number, nothing really bullish or bearish, which again is going to be interpreted as a bullish move. So that's going to give us a little bit of a push to the upside again.
Excellent. Until next week, this is your pregame show. I am David Ramsden Wood with Mark Rossano, and we appreciate you joining us. Hope it helps.
Thank you.